Welcome back. We have just under 2 minutes here until the closing bell. And you're looking at a market that hasn't moved too far in the past hour. We're looking at the NASDAQ continues to be the outperformer today, up just around 0.5%. The S&P holding on to gains. The Dow not too far from the flat line. It could still flip positive in the final minute of trading. Taking a look at some of the movers today, the reopening plays, giving the broader market a boost. We mentioned earlier in the show some of those cruise lines that are outperforming today. Carnival, Royal Caribbean, Norwegian, they're leading the way. Some of the airlines are also in favor today amongst investors. We see American, Delta, and United outperforming. Sector-wise, we're looking at communication services as one of the leaders, energy, as well as consumer discretionary. On the flip side, healthcare weighing on the broader market, as well as consumer staples. A couple of individual names that we want to point out to you as we head into the closing bell. Gap, it will be an important name to watch, not only into the close, but also into tomorrow. It's one of the best performers in the S&P today. Morgan Stanley raising its price target on the stock. We will hear from that company after the bell tomorrow when they report earnings. So it's certainly a name to keep in mind. And then also Peloton, an outperformer today. It's one of the trending tickers on Yahoo Finance. It was a top pick at JP Morgan. The stock closing up today just around 10%.
All right, we have a closing bell. Let's see where things are going to settle as the markets are now coming. Oh, look at that. We're going to be in the green across the screen. The Dow up about 10 points. It had been negative briefly. S&P 500 is going to be up about almost 8 points. It's going to settle there. And then the NASDAQ will be up about 80 points. We're just mentioning the Dow. Some of the winners on the Dow today, Nike, Salesforce.com, Dow, Goldman Sachs, Travelers, they're big winners, all up between about 1 to almost 2%. Some of the losers on the Dow today include Walgreens Boots Alliance. It was down 4%. Amgen was off almost 1.5%, and then Visa was off about 1%. Let's bring in our guest, Stephen Dover from Franklin Templeton's Chief Market Strategist. Also want to bring in David Ragland, IRC Wealth CEO. Gentlemen, good to have both of you here. David, let me start with you. So when we look at where the values are right now, the value index especially, up about 99%, the Russell Value Index. What do you think that's signaling to investors as we are going forward with the reopening trade?
I think you still have more room to run if you're a value investor at this point, because when you look at certain selected groups such as financials, energies, cyclicals, they still have a lot of room to run with low PEs, as well as historically coming off of major market bottoms. They can be up 150, 175, 200% top to bottom.
Hey, Stephen, what's your strategy right now? I think a lot of investors are trying to figure out whether or not we'll see a bigger pullback. I mean, the market hasn't moved too much over the last several trading days. Is now the time to get a little bit more aggressive and take a more risk-on approach, or is it time to do the opposite?
We've actually been doing the opposite. We've been heavily overweight equity this past year. And as that equity market's kind of run above the overweight that we have, we think people should pull back a little bit on their gains. That doesn't mean we're not overweight equity. We're still very overweight equity. It's our preferred asset class, but we think it's been an opportunity to consolidate. Just on a comment on value versus growth, that tipping point really happened in November of last year with the Pfizer announcement of the vaccine. And we would agree that we see more opportunity as the economy expands in value stocks in the United States, but also outside of the United States.
David, did you want to add to that, respond to Shauna's question?
I think what you're seeing is the opportunity with rising interest rates for developed markets, smaller cap stocks, especially from the value sectors, to allow that growth to continue at this point in time.
So I wanted to follow up with you too, David, on what kind of recovery we're actually seeing. There's been this debate whether it was the V-shaped recovery or if it was the K-shaped recovery. What does that mean for an investor? Does it really matter whether it's V or K? Because you're still going to find the stocks to invest in somewhere. I mean, it doesn't matter what the economy, the recovery looks like, does it?
Well, I don't think V versus K really matters. I think what really mattered was lockdown stocks. Now you have the reopening stocks. You look at For example, today the cruise lines were up dramatically because they're going to be able to start cruising hopefully in July. You're looking at the airline stocks, Delta, United were up big today as well. I'm going on a trip in a couple days over Memorial Day myself. So I think you really have to be prudent with your selections at this point in time, because you have had a lot of things run dramatically, but you still have a lot of stocks that were more in the entertainment, lodging, hospitalities that are not anywhere close to their pre-pandemic high. So I think this market is more fundamental stocks, individual stock selection is more important than a broad-based look at the market.
Stephen, is there anything that would change your view just of the market over the short term? We know that there's this wall of worry out there. There certainly are a number of concerns from investors, one of them, of course, being inflation. But is there any key data point that you could potentially point to that you're worried about here over, at least in the short term?
Yeah, I think that would be wage pressure growth, especially at the lower level. That's where we see the opportunity. We think there'll be a short spike in inflation. We don't think it'll be permanent over a longer period of time. Stimulus is going to roll off in next year, which will reduce the possibility of inflation. But inflation is going to happen if wages start to move up, and so that would be the key indicator we would look at. Inflation, while we don't think is going to be the problem, it is the canary in the coal mine that we really have to keep our eye on.
We're going to keep talking with the panel about where these markets are headed. And let's go back, Stephen. We had a guest on in the last hour talking about, if you're looking at your portfolio and maybe even rebalancing, the horizon to consider would be something like 18 to 24 months. What do you see happening within that horizon? Should we be looking even longer than that, or should we be looking shorter than that?
Well, I think you always have to have a long-term horizon. We're not big on trading stocks back and forth on a short-term basis, but there are some really big things that are going to happen in the next 18 months, 2 years. The biggest being the stimulus is going to no longer exist. So stimulus is a marginal. It was a marginal amount that came into our economy, and those were direct payments that came to people, and those are falling off next year. So we have to look at that horizon. We think earnings growth is going to continue. PE ratios are a bit high. We think earnings growth will be higher than PE ratios, which typically during this part of the market cycle tend to go down a little bit. They haven't, but we anticipate that happening. So I think there will be a change in outlook in the market in the next 18 months to 2 years. That's also the time period where we probably won't have this constant discussion about inflation. We'll know whether inflation was transitory, meaning past tense, or we'll know whether it's a permanent feature that we have to deal with.
I think we all look forward to that day when we know for sure exactly what we are in for here over the next couple of months. David, let me ask you about the recent econ data that we've gotten. We got consumer confidence out yesterday, also the new home sales, that both of those pulling back just a bit. When you take a look at the fact that some of this, the momentum that we've seen in the economy taking a little bit of a break, how is the market looking at that? And I guess how worried should investors be?
I think the market has been so far up over the last 12 months that we've entered into a more consolidation mode. And I think from an overall sentiment standpoint, it's actually a good thing that individuals and investors, their sentiment has actually come down. They're less bullish today than they were 6 weeks ago, 8 weeks ago. That's actually a good thing to see, prices start to moderate as far as lumber prices from an inflationary standpoint. So I think we'll take a temporary dip in sentiment, maybe a temporary dip in asset prices that will provide the groundwork for future market moves higher over the next 12 to 24 months. And as a piggyback on the comment regarding what do we see in the next 18 to 24 months is we're going to see a market that we believe is going to edge higher. It's really when we get 18 months, 24 months from now, when the stimulus has run out, if there's an infrastructure bill, those payments have actually come through the system. What happens to the economy? What happens to earnings? What happens to inflation when all of those transitory stimulus are out of the economy? That's the real big question, not today, but what happens to the market 2 years from now.
Let's take a breather and talk about what's happening right now with Okta, because those shares are trading after hours up about 2%. Jared Blickery, how'd they do on their earnings report?
That's right. We saw them as high as 5%. I'll give you the numbers here. Guidance was a little bit mixed, but beats on both the top and bottom lines for the reporting quarter. Revenue coming in at $251 million. That's up 37% year over year. Estimate was for lower at $239.1 million. Subscription revenue, $240.1 million. That's up 38% year over year. Billings, $364 million, up 74%. And then adjusted operating margin, that was down 6%. Last year was down 7%. So adjusted gross margin coming in at 78%. That is higher than the estimates of 77.8%. Now on their revenue forecast, it beat expectations, but on the adjusted loss per share side, basically double what the street was expecting, $1.13 to $1.16, when the estimate was for a loss per share of about 43 cents. Nevertheless, investors seem to be shrugging that off right now on the beats on both its top and bottom lines.
All right, thanks, Jared. We want to get to another earnings report, Workday. It doesn't look like investors are shrugging off those numbers. Shares off just over 1%. Emily McCormick has that for us. Emily?
Well, Shauna, we're taking a look here at Workday actually beating expectations on the top and bottom line for fiscal first quarter results. Revenue coming in at $1.18 billion, whereas $1.16 billion had been expected. And that actual revenue did come in about 15% higher than it was in the same quarter of last year, and also grew from the $825 million from the first quarter of calendar 2019. Now, taking a look here by segment, subscription services revenue came in at $1.03 billion, just a touch above estimates for $1.02 billion. That business unit does comprise the vast majority of sales for Workday, although we did see professional services revenue up 4.7% and also beating expectations for the first quarter. Now, taking a look here at bottom line results, adjusted earnings coming in at 87 cents per share versus the 73 cents expected. So again, a beat there on the bottom line, as well as we also saw adjusted operating margin come in at 24.6% and widening sharply from the 12.8% in the same period of last year. Now, taking a look at guidance, Workday seeing full year subscription revenue coming in between $4.43 billion and $4.44 billion for growth of about 17%. That was also ahead of the street's estimate, but do want to highlight that we are seeing shares fluctuating a bit here in the after hours session, had been off a bit. One of the things that Wall Street might be homing in on is the fact that Workday did say that it plans to increase its headcount. The company is planning to increase its global headcount by more than 20%, or by more than 2,500 hires in the current fiscal year. So expectations of those increased compensation expenses, potentially something weighing here on the stock in after hours trading. Shauna and Adam.
All right, Emily McCormick, thanks so much. And our thanks to our panel today, Stephen Dover of Franklin Templeton, and also David Ragland of our IRC Wealth.